Welcome to AI Ticker Recap, the after show where we take a daily look at the charts and stocks discussed in various financial media and share our own independent technical analysis. We are not affiliated with any of the networks or shows we mention. This podcast is for informational and entertainment purposes only. Please note, this show is AI generated. While we strive for accuracy, there may be errors or omissions, so always do your own research and consult a qualified professional before making any investment decisions. Nothing on this podcast should be considered financial advice. Today, we're cracking open a really interesting market call from BNN Bloomberg. It features energy expert Eric Nuttall.
Yeah, we've got the transcript right here. He gets into his outlook on oil, gas, and, well, a whole bunch of specific energy stocks. Lots of listener questions driving it.
Exactly. So our mission for you today is to basically cut through all that, pull out the key bits Eric shared, especially about the companies he discussed. We want to understand his take on where the value is, right now in energy.
We'll definitely focus on those companies, mention the tickers too, and really unpack why he feels the way he does about each one. It's about getting you informed fast.
Okay, so just to set the scene a bit, Eric Nuttall, he's a partner, senior portfolio manager at 9 Point Partners, focuses right on energy.
Right. And the source material, it kicks off with his sort of macro view. He notes some current weakness in oil prices.
What's behind that, according to him?
Well, he points to a few things. Concerns about China's demand. For one, then there's OPEC plus actions, some members bringing barrels back, maybe others producing more than they should.
Okay.
And also the outlook for U.S. shale supply.
Yeah.
He really sees U.S. shale as the key balancing act in the market.
How so?
He figures around $60 oil. U.S. shale production is probably flat, maybe even down a bit, like 500,000 barrels a day. But get closer to $50 and you'd see a much bigger drop.
Got it. But natural gas, that's a different story for him.
Oh, yeah. Much more positive view there, especially looking out longer term.
Even with prices bouncing around a bit lately.
Yeah, he acknowledges that short-term volatility, shoulder season stuff. But the big picture for him is significant demand growth coming.
Where's that demand coming from?
He really highlights the massive U.S. LNG buildout. Exports going from, 16 billion cubic feet a day now, potentially up to 28 by the end of the decade. That's huge.
And for Canadian gas, any specific catalysts?
Definitely. He expects LNG Canada's first export shipment pretty soon. That tightens up the domestic market for Canadian gas, and he thinks it'll shrink that price discount Canadian producers usually get.
Like how the TMX pipeline helped oil prices.
Exactly that kind of effect. He sees that Canadian gas discount falling quite a bit. Plus, he points to this structural jump in U.S. power demand, maybe 25% increase, and gas is filling a lot of that gap.
Why gas specifically?
Well, as he puts it, you just can't meet that kind of jump with only intermittent renewables or coal. So you've got strong demand growth, and the supply is increasingly coming from higher cost areas.
So where does he see prices going?
He's thinking gas trades roughly $4 to $5 over the next year or so, maybe even $6 this summer if the weather gets hot.
Okay, that's a helpful macro backdrop. Before we dive into the specific stocks, it seems like there are some core themes in how he looks at these companies, right? Especially Canadian ones.
Absolutely. You see it again and again in the transcript. He consistently emphasizes the strategic value of Canadian assets, oil sands, deep basin natural gas. He thinks this value is actually rising.
Why rising now?
Because, and this is a key phrase he uses, he believes the twilight of shale is upon us in the U.S., meaning U.S. production growth faces some serious long-term challenges, finding new spots to drill.
Okay, so U.S. challenges make Canadian assets more valuable.
That's the idea.
Yeah.
And then he really focuses on companies with high-quality, long-life inventory, assets that can keep producing for decades without massive spending to replace reserves.
Makes sense. What else?
Strong balance sheets are crucial, ideally debt-free or at least paying down debt quickly. And maybe the biggest thing, he looks for companies committed to returning cash to shareholders.
Wow. Dividends.
Dividends, yes, but especially significant share buybacks. He really believes that compounding effect of buybacks, reducing the share count over time, is a massive driver of value per share.
Okay, that's a clear framework. Strategic Canadian assets, long life inventory, strong balance sheets, and return of capital, especially buybacks. Let's apply that. First question came from Luke, asking about tariffs impacting Canadian energy producers.
Right, tariffs. Eric's take was pretty definitive on this one, almost surprisingly so. He basically doesn't see major tariffs hitting the Canadian energy sector. He feels they should all be exempt.
Why exempt? What's the reasoning?
He argues it would just be massively inflationary for the U.S. I mean, they import millions of barrels of Canadian oil, especially heavy oil going into places like Chicago refineries. There's just no easy replacement for that.
So the U.S. needs the energy too much to tariff it.
That's his view, both the oil and the natural gas. He mentioned U.S. refineries specifically built to handle Canadian heavy crude. Sure, there might be minor impacts from tariffs on things like steel pipes, but nothing major hitting the producers directly based on what he's heard.
So bottom line, not a major worry for him.
Pretty much, yeah. He expects no major tariffs on Canadian energy.
Okay, good to know. Let's shift from that macro worry to a specific company. Stu asked about Headwater Exploration, ticker HWX.
Headwater. Yeah, he sees it as a high-quality small cap, about a $1.5 billion market cap, focused on the Clearwater play.
And what does he like about their Clearwater operations?
They've had really good success with something called water floods. It's where they inject water to keep the reservoir pressure up. This lets them hold production pretty flat at a very low operating cost.
Low cost, flat production. Sounds good. What about returns?
He figures they're yielding about 7% right now, and he thinks that dividend is safe even if oil drops down towards $50. He actually called it a get-paid-to-wait stock.
Get paid to wait. So even though he's a bit cautious on oil short term?
Exactly. Okay. He mentioned being neutral, maybe a little bearish on oil for the next, say, 9 months while the market absorbs those OPEC barrels coming back. But Headwater's quality, the fact it's debt-free, that high yield, he sees it as a good name if you want that income and stability while waiting for oil prices to potentially move higher.
He owns it, but mainly in one specific fund.
Yeah, he mentioned owning it in their income fund, less so in the main fund. Suggests it fits that income profile particularly well.
Okay. Now let's talk oil sands. We had questions from JC about Athabasca Oil, ticker AEH, and from Daniel comparing mid-caps like Athabasca or Meg Energy, MEG, to a giant like Imperial Oil, IMO.
Right, oil sands. He tackled Athabasca first. He sees ATH as like a prime example of his whole thesis about the overlooked strategic value of Canadian oil sands.
And just remind us, why does he see that value going up now?
Again, it comes back to that twilight of shale idea of the U.S. He sees U.S. production facing inventory challenges down the road, but global oil demand still expected to grow for years, he thinks, while most other places are seeing production decline.
So the long-life Canadian stuff becomes more critical.
Exactly. And he says Athabasca and Meg are perfectly positioned there. For Athabasca specifically, he highlighted, get this, well over 50 years of inventory where they can just keep production flat. Minimal new drilling needed.
50 years, wow.
Yeah. Plus, ATH is debt-free. They're not really focused on growing production. Instead, they're using basically all their free cash flow to buy back stock. Yeah. He thinks there might even be a little takeover premium priced in.
What kind of valuation does he see?
At $70 oil, he estimates it's trading around an 11% free cash flow yield. He owns it. It's a pretty big position for him, around 7.5%. Very positive on the management team, too. Says it's a great name if you're neutral to bullish on oil.
And comparing those mid-caps to Imperial Oil.
Right. So when Daniel asked, he first clarified, Imperial Oil, IMO, is a $50 billion giant, definitely not a mid-cap. In his view, the only real mid-cap oil sands players are Athabasca, A8, and Meg Energy, MEG. And he owns both in size.
What's the common theme between 8 and MEG for him?
Deep inventory, that stay-flat model, only modest growth, and really hitting those buybacks hard with free cash flow. He believes both can do phenomenally well if oil is $70 or higher, which he expects maybe 9 to 12 months out.
But he wasn't keen on Imperial Oil, IMO.
No, not really. He feels it trades at a massive, massive premium that he just doesn't get. Says it doesn't look attractive on valuation metrics like cash flow yield. Maybe it's seen as a safe harbor, he mused, but he said he'd way rather own a CNQ, that's Canadian Natural Resources, ticker CNQ.
Although he doesn't own CNQ right now.
Correct, because of his short-term caution on oil. But if you just want that pure oil exposure in the mid-cap space, he points back to MEG, MEG, or Athabasca, ATH.
And between those two, any preference?
He slightly prefers Athabasca, ATH, cites less M&A risk hanging over it, the fact it's debt-free, and that 100% commitment to buybacks, sees meaningful upside there. He called both Athabasca and MEG very special companies, hard to find globally, and he's not selling them anywhere near current prices. His 3 oil holdings again, Tamarack Valley, TVE, Athabasca, ATH, and MEG.
Okay, let's move on. John from London asked about Whitecap, WCP, specifically after it acquired Varen.
Whitecap and Varen. Yeah, this is a bit of a sore spot for Eric. He had big positions in both Varen and MEG before. He feels quite strongly that Varen was essentially stolen by Whitecap. which I guess speaks volumes about how much he liked Varen's assets and drilling program.
Right, but that's history now. What's his view on Whitecap WCP today, post-deal?
Well, he doesn't own it in his main fund right now. Again, that reflects his sort of neutral short-term oil view compared to his gas weighting. But he sees massive value in the combined Whitecap stock. He still thinks the Whitecap team got that asset for his steal.
Even though he wasn't always a fan of Whitecap's strategy?
Right. He mentioned he previously disliked their tendency to issue stock for acquisitions, which can weigh on the share price. But now, with the Varen assets combined, he thinks the inventory is totally fine. Several decades of stay-flat potential.
And the return proposition.
Huge draw here.
Yeah.
You're getting paid an 8.6% dividend yield. He called that unbelievably attractive and thinks it's sustainable even if oil dips into the low $50. They could even cut growth spending and still easily cover that dividend.
What about valuation?
At $60 oil next year, he calculates it trades at just 4 times cash flow. And because it's a bigger, more visible company now, he expects the valuation multiple to expand over time, or the yield to compress. He thinks it's meaningfully mispriced. At $70 oil, he figures a 5x multiple points to a $14 target price.
Okay. Now, for what listener Alan called the elephant in the room, Meg Energy. Meg.
Ah, yes, Meg. Currently facing that second hostile bid in a decade from Strathcona, led by Adam Waterous. Eric is very clearly opposed to this deal.
He used some strong words, I recall.
He did. Called the bid laughable. So the premium, around 9%, is a massive undervaluation of Meg's asset. He respects Adam Waterous, he said, but he really dislikes the hostile nature of this bid.
And his core view on Meg as a standalone company?
He sees it as unique, a single, super high-quality oil sands asset. Modest growth, sticking to that playbook.
Yes.
Use all the free cash flow for buybacks. Given his medium-term bullish oil view, say $70, he calculates Meg could buy back over half its stock in the next 5 years at the current price.
Which would make the remaining shares much more valuable.
Exactly. That compounding effect again. And he just doesn't see the Strathcona offer being better for shareholders. He thinks Strathcona's assets aren't as good, so it would dilute Meg's quality. Shareholders would get less liquidity, lower quality inventory in the combined company.
And he likes Meg's current management.
Very much so. Called them extremely shareholder-friendly. He made the point that M&A usually solves a problem, like a bad balance sheet or weak inventory. Meg doesn't have those problems. So other than that small premium, he asks, what's really in it for the shareholder compared to just letting those buybacks work?
He thinks the bid price is way too low.
Absolutely. Bottom of the cycle pricing, he called it. Believes fair value is meaningfully higher. He really urged investors listening to take the long view. Don't trip over pennies on your way to dollars. He strongly feels shareholders will make much more money letting the buybacks compound.
Does he think the deal will happen at this price? Or might others get interested?
He doesn't think it sells at this price. And yes, he anticipates other potential bidders might emerge if Strathcona fails, given the asset quality. He threw out names like Cenovus, CVE, maybe Imperial, IMO, even ConocoPhillips, COP. As one of Meg's largest shareholders, he's clearly hoping it stays independent or gets a much better offer.
Okay, shifting gears a bit towards natural gas. John from Toronto asked about Tourmaline, TOU.
Yeah.
Strong CEO, good growth, he noted.
Right. Tourmaline. Eric's still a long-term gas bull, thinks gas is the fuel of now, driven by LNG and power demand. Tourmaline is about a 5% weight for him, but interestingly, he called it one of our last favorite gas names.
Last favorite. Why? He agrees the CEO is good, inventory's good.
He does agree with those points, and they had a high dividend. But his main issue, his critique, is that historically, Tourmaline has been more keen to grow by drilling, even during downturns, instead of stopping the drills and buying back stock aggressively, which he says they don't really do.
He prefers the buyback model more.
Definitely. He feels there are better names out there really focused on buybacks. Tourmaline has leaned more towards dividends, base, and variable ones, but he also feels their constant acquisitiveness, often using stock for deals, creates this persistent overhang on the share price.
Leading to underperformance.
Yeah, he pointed out it's lagged many of its gas peers recently, both in the U.S. and Canada. He pins that chronic underperformance, as he called it, on that incessant issuance of stock for acquisitions.
Okay. Next, Michael from Vancouver asked about freehold royalties, FRU. Is it still in the portfolio? Still like it. And also a broader question, does Eric ever buy stocks just because they're cheap, even if he doesn't like management or the assets?
Let's take the second question first. His answer was a very firm no. He absolutely does not buy stocks purely on valuation if he dislikes management or assets. Said he's been doing this long enough to know if you buy junk, it always comes and bites you in the behind eventually.
Okay, clear enough. And that doesn't apply to freehold, FRU.
No, neither issue applies to freehold, in his view. He described FRU as very boring, low risk, low vol name with not a lot of upside. Doesn't sound super exciting, maybe.
Huh, maybe not. But he owns it.
Yes, in the income fund, and personally. Why? Because it's yielding 8.8%, and he sees that dividend as sustainable down to $50 oil. So you get that steady income, plus you still have that long-term potential upside if oil and gas prices move higher.
Any recent positive signs?
He did mention their last quarter showed better than expected volume growth from their U.S. assets, like in the Permian. So it's not a stock to get rich quick on, he says, but it offers lower volatility, less risk. Remember, royalty companies don't drill themselves. Others pay them, and a very, very sustainable yield.
Interesting point about the valuation, too.
Yeah, he noted it trades at about half the multiple of Prairie Sky Royalties, PSK. Now, he grants freehold's assets maybe aren't quite as good as PSK's, but still, that's a heck of a chasm in valuation. He finds it interesting that it trades more like a traditional oil company now, whereas royalties used to command a premium.
All right, let's pivot to the past picks review. Looking back at recommendations from May last year, how did they fare?
Yeah, this really highlights the commodity price impact. It was quite a mixed bag. First, Baytex Energy, BTE.
Yeah.
Recommended at $4.62. It was down to $2.34. That's a pretty steep 49% drop.
Ouch. What drove that?
Straight up, the oil price, according to Eric. He said Baytex is highly leveraged to oil, so when prices sell off, it gets hit hard. He actually sold the position for his fund around the $4 mark he mentioned.
So it really needs higher oil to work.
Massively leveraged, yeah. He said at $70 plus oil, it's exceptionally well, maybe almost a 25% free cash flow yield, but dropped to $60 oil. That yield collapses to maybe 1%. Not much room for buybacks then. He'd only revisit it if he got more bullish on oil. Needs $60 or lower to help balance U.S. shale, but BTE itself doesn't offer much upside at $60.
Okay. Next past pick. Precision Drilling, PD, on the TSX. Recommended at $95.02, down to $59.95, another drop, 37%.
Right, PE. He sold this one much higher, he said. High $80, low $90. And again, highly susceptible to oil prices. When oil falls, shale companies stop drilling, they lay down rigs. And PD owns the rigs.
So less drilling activity hits their bottom line directly.
Exactly. He expects the rig count could fall quite a bit, maybe 40, 50 rigs, if oil stays around $60. That means lower utilization for PD, lower pricing for their services. He expressed low confidence in their stated 28% free cash flow yield under those conditions because of that pricing pressure.
When might he look at it again?
Maybe in 6 months or so, once the market digests the OPEC supply better, and if he gets more constructive on oil. Gas activity helps PD a bit, but oil really moves the needle for them.
Okay, but one past pick did well. ARC Resources, ARX. Recommended at $25.06. It was up to $29.29, a 17% gain.
Yeah, and he really used this to illustrate the point. Oil down, oil stocks shellacked, as he put it, gas flat to up, and gas names like ARC have done well. He sees a lot of that as rotation out of oil into gas because the short-term macro for gas just looks significantly better right now.
Anything specific about ARC he highlighted?
Well, he mentioned they recently bought some assets from Strathcona. Yes, the same company trying to buy MEG. He saw that deal as positive for ARC's value. But mostly, he likes ARC for its decades of high-quality inventory, really strong management and board, and their commitment to buying back stock with all their free cash flow for the next couple of years. Sees them as a huge beneficiary of that compounding buyback effect.
Got it. Let's get back to listener questions. Paul from Orangeville asked about Peyto Exploration and Development, ticker PEY.
Peyto. Yeah, Eric likes Peyto a lot. Noted it's done very well, hit a 52-week high recently. He sees it as a good way to get exposure to the Deep Basin if you're bullish on natural gas, thinking prices will be in that $4, $5 range for years.
What are the specifics he likes about Peyto, PEY?
He mentioned an acquisition they did from Repsol mid-last year, called it a hand-in-glove fit. Really good asset overlap. Thinks they're doing an awesome job grinding costs down. And he highlighted their hedging strategy.
Hedging? How so?
They've apparently hedged out their gas production for a few years. He sees this as giving them a sort of unique protection, limiting downside risk, but still allowing some upside participation. Plus, you get paid to wait.
What's the yield?
Currently 6.9%, and he thinks that's sustainable down to $2.75 gas. Very good yield. And the kicker, as they pay down debt, which he expects around June next year, he anticipates a meaningful dividend increase, maybe 20% plus.
So that 7% could become over 8%.
That's the potential, yeah. So another get-paid-to-wait story. Benefits from strong gas prices eventually. Catalysts like LNG Canada. He said there's a lot to like there.
Okay. Paul also asked about Vermilion Energy, VET. Is there upside or maybe time to get out?
Eric's answer here was pretty blunt. He basically said you will like life a lot better if you just sell the name. Suggested taking the loss and moving into some of the other names they discussed that he prefers.
Ouch. So no real investment case there for him.
Not really. He said there's no thesis for Vermilion VET, in his view. Sees them kind of pivoting away from scattered international assets where he felt execution wasn't great, back towards what he termed more marginal assets in the Montney. Just doesn't see why you'd own it compared to other options.
Yeah.
Cut your losses, was his advice.
All right. Frank brought up an interesting point about the sector's cyclicality. Narrative swings from running out of oil to too much oil. Price stays in that $50–$80 range. His question, as a small investor, why not buy names like CNQ or Baytex, BTE?
Yeah.
Now, during the downturn, if you believe oil will still be needed.
Yeah, it's a good question. And Eric agreed with the basic premise. The sector is cyclical, it is near lows, and it looks attractively priced. He acknowledged his bias running an energy fund. However,
There's a but.
there's a but. It comes back to his short-term view. He prefers gas over oil right now, and that's specifically why they don't own C&Q at the moment.
But he likes CNQ as a company, long term.
Oh, absolutely. Called it exceptionally well run. Praised the team, Murray Edwards. Super high quality, very deep resource base. And he strongly believes that strategic value of the oil sands, which C&Q has a lot of, is only going up in time, especially with U.S. shale facing challenges.
So purely a timing issue for him not owning CNQ now.
Pretty much. He agrees we're in a down cycle, maybe approaching lows, but he feels there's a little more time to wait, hence the higher gas waiting for now. Since C&Q is mostly an oil story, it's on the sidelines for him today.
Even though it pays a dividend and has a strong balance sheet.
Yeah, he acknowledged all that. 5.5% yield, strong balance sheet, great track record of smart acquisitions, and paying down debt. You do get paid to wait with C&Q. But he also noted other names offer even higher yields right now with a similar shareholder return focus. He sees C&Q as a large-cap defensive play that got massively sold off this year, partly that sell Canada sentiment, tariff worries he thinks are history. Sees meaningful upside, just a question of timing the oil turn.
Okay. Greg asked about the drillers, how they've pulled back heavily. He owns Ensign Energy Services, ESI. Noted Fairfax's passive stake, Murray Edwards buying low. He asked, is it a stranded asset? Why is Edwards involved?
Right, Ensign, ESI. Eric agreed. Drillers have pulled back hard. Sentiment is very challenged. Ensign is a small cap, he noted, struggles when things are tough, often too small for big institutional investors.
He mentioned seeing some M&A in the services space.
Yeah, and not necessarily good M&A.
Yeah.
He sees companies maybe taking advantage of distressed valuations, names getting stolen, as he put it. Thematically, he finds the whole services sector hugely challenged short-term. Massive headwinds, especially for companies with a lot of debt.
What about the idea of buying because of potential M&A? Like maybe Fairfax or Edwards would take Ensign out.
He was very clear on this. He would never make potential M&A the reason for investing. His experience is, if a company is an M&A target at a distressed price, there's usually a problem. Either it's misvalued for a reason, or it has balance sheet issues. He didn't directly call Ensign stranded, but definitely painted a picture of a challenged sector and cautioned against basing investment hopes on a buyout.
Okay. Jack from Montebello asked about Chord Energy. Chord. He bought it after the Enerplus takeover, feels it's been a dog stuck around $100, while analysts have targets way higher, like 150+ TAC. What's Eric's take?
Chord. Yeah, Eric admitted he was tempted not long ago. He made an interesting point about the U.S. energy sector. It's actually pretty small overall, like 4% of the total U.S. market.
Yeah.
Often kind of irrelevant to generalist U.S. investors.
So when sentiment is weak, like now with demand worries.
Exactly. The appetite for U.S. energy stocks just isn't there. He called Chord a mid-cap, about $5.5 billion market cap, and said basically, nobody cares, nobody's looking.
But is the company itself okay? Does the value exist?
He thinks the value's there, yes. But it needs that sentiment shift, which he feels is maybe harder to get for U.S. names right now compared to Canadian ones. He called the company itself fine. Got 10+ years of stay-flat inventory in the Bakken, decent well results, drilling longer laterals. He even mentioned consultants suggesting Bakken potential might be longer lived than thought, maybe 4 years inventory, which he sees as positive for the bigger oil picture.
So for Jack, holding a U.S. stock, sitting on a loss, not getting a huge dividend, 5.4%, no Canadian tax benefit. What's the advice?
Eric suggested considering a switch. sell cord, CORD, maybe move into Whitecap, WCP. His rationale, Whitecap offers a higher dividend, it's more tax efficient for Canadians, has a deeper resource base, decades of inventory, plus gets some benefit from LNG Canada since WCP has gas exposure. He called that a very good switch, potentially.
Okay. Michael from Montreal asked about Cenovus Energy, CVE. Noted they beat earnings recently, raised the dividend. Does Eric see them maybe acquiring MEG or Athabasca? Or could Suncor SU acquire Cenovus?
M&A first. Eric's hope is definitely not Suncor acquiring Cenovus. Focusing on Cenovus, CVE itself, he feels the downstream side, the refineries, have been plaguing them. Started losing money recently.
But are they fixing it?
He thinks so. Said they seem to be righting the ship, making changes, personnel, maintenance turnarounds. Heard positive signs on their last call. But, he cautioned, it usually takes a couple of years to get refinery operations up to par with the best operators.
What about their upstream, the oil production side?
That he called spectacular quality. No mine life issues like he sees at Suncor. So it's really an oil story stock, he thinks. You need to be right on the oil price call.
So potential is there, but maybe waiting for a catalyst.
Exactly. He believes fair value is a lot higher, but struggles with the timing. Those downstream improvements, while necessary, probably won't excite the market until maybe Q3 results. He likes the management team, wants to be a shareholder eventually, but feels he need to be a bit more bullish on oil short term to jump in right now. Thinks the stock will rally once those downstream issues are clearly fixed.
All right, let's wrap up with the new picks Eric shared. First, a U.S. natural gas name, Expands Energy. He didn't give a ticker for this one.
Right. Expands Energy, U.S. gas play. He noted there aren't actually that many big U.S. gas producers, which he thinks could mean a scarcity premium eventually. The AI data center demand boost for gas is there, but it's not his main reason for being bullish.
What is the main reason then?
It's really that huge LNG export build-out happening on the U.S. Gulf Coast. That's the big structural demand driver.
And Expands Energy is well positioned for that.
He thinks so. It's large enough, mentioned a $27 billion market cap, so big funds can buy it. Has over 20 years of stay-flat inventory. Crucially, its assets are located close to those Gulf Coast LNG facilities, which should give it a pricing advantage over gas producers further away.
So leveraging location and the big demand trend.
Exactly. He expects gas prices to firm up, $4 or $5 range, maybe $6 this summer. Expands is highly leveraged to that. He noted it still trades at a discount to EQT, another big U.S. gas name he also owns, about 10% weight in both. Sees potential catalysts from pipeline news, too. Thinks the stock should start working as gas prices rise post-shoulder season.
Okay, second new pick, back to Canada, NuVista Energy. Also, no ticker provided in the source.
NuVista. He called this a simple thesis. Get exposure to both natural gas and condensate. Condensate is that light oil, high demand in the oil sands for blending. NuVista's plan is to grow production 33% over the next few years and then hold it flat for 28 years.
28 years flat. That fits his long life inventory theme perfectly.
Absolutely. He also sees M&A potential, looking at recent deals. Thinks NuVista's assets could be worth $18, $20 based on comparable transactions. But again, he stressed the real money is made in the wait.
Waiting for the buybacks to compound.
You got it. They're using almost all free cash flow for buybacks. His math. At constant $4 gas and $60, $70 oil, they could buy back a third to over half their stock in 5 years, while growing production 33%. Projecting out, he even suggested that in 5 years, the remaining company could potentially support a 13%, 19% annual dividend yield for the next 28 years.
Wow, that's the power of the buyback on long life assets he talks about.
That's the core idea, especially in Canada, where he sees that strategic value rising. NuVista is his second largest weight, and he's the second largest shareholder.
And the final new pick, one of his 3 oil names, Tamarack Valley Energy, TVE, on the TSS.
Tamarack Valley, TVE, yes. His third oil holding. Even at current oil prices, he sees it trading at a 10% free cash flow yield. If oil hits $70, that yield jumps to 17%. The dividend is 3.4%, but he thinks it's sustainable all the way down to 42 oil.
Why so sustainable? Asset quality.
Exactly. Primarily assets in the Clearwater play, which he calls one of the most economic plays in North America. He highlighted their exceptional results from water floods there again, keeping production up cheaply. And, no surprise, the compounding impact of buybacks is key.
How much buyback potential?
At $70 oil next year, he believes they could buy back at least half their stock over 5 years. They also have over 20 years of stay-flat inventory. He sees it as a very similar story and theme to his oil sands holdings, 8A and MEG. Those 3, Tamarack, Athabasca, MEG, are his oil beds.
Okay, one final point from the source. Morella asked about a general comfort level price for oil producers. If Tamarack's okay down to $42, what's the average break even?
Eric put that number at $51 to be exact. That's the average price producers need to generate enough cash flow to pay their base dividend, which they never want to cut, and just keep production flat.
And he doesn't think they should be growing production right now.
Correct. Not with OPEC returning barrels and demand growth maybe slowing a bit. He sees U.S. shale as the mechanism that will balance the market based on price. Since producers only need $51 to sustain, he thinks the market really needs oil around $60 or higher to incentivize any growth. Below $60, he expects U.S. shale output to fall, and he's seeing signs of that already from companies.
So once things normalize.
Right. Once the market absorbs OPEC's spare capacity and gets past any demand funk, he remains positive on energy stocks. But for now, he's positioned more towards natural gas, keeping a close eye on how the oil situation plays out.
Okay, wow. We have definitely covered a lot of ground there in this deep dive, really pulling from that source material you brought. We hit the macro for oil and gas, dug into Eric Nuttall's detailed views on, over a dozen specific stocks, tickers included, and really explored his core investing ideas.
Yeah, the key themes really came through from his perspective, didn't they? That rising strategic value of Canadian assets, oil sands, deep basin, the focus on quality, long life inventory, strong balance sheets, and that huge emphasis on returning cash, especially through buybacks and sustainable dividends.
And the current positioning, cautious on oil short term, sees medium term upside, but definitely more bullish on the near term setup for natural gas.
Exactly. Hopefully, unpacking all that gives you, the listener, a much clearer picture of what this particular expert thinks is driving value for these specific companies right now. Helps sort through the noise.
We heard that phrase twilight of shale a few times, contrasted with the long-life Canadian reserves, and that recurring idea that maybe the real money, especially with buybacks, is made in the wait.
Right. So maybe a final thought to leave you with. As you look at the energy landscape, you hear this expert making a strong case for patience, for focusing on high-quality, low-cost assets in stable places, combined with those aggressive buybacks, especially in a world that still clearly needs energy and might face supply challenges.
The provocative question then becomes, is that patient compounding approach the most compelling path forward? Or are there other big factors, maybe the speed and shape of the energy transition, for example, that might fundamentally change what value looks like in this sector over the next 10, 20 years? Something to keep thinking about as you continue learning.